I just mentioned how brutal it's been. Equity markets, we've heard about the drawdown, bear market and the like. It's been worse for fixed income.
Yeah, not worse in a kind of outright return sense, but worse in terms of the expectations. Normally you would think fixed income is going to do, small positives. So to see a 10% drawdown in bonds is pretty big.
So the key question now is, what are people looking at the bond market and they're saying, okay, we're seeing flattening curves at the moment. We've got a whole bunch of people talking about recession. You've been studying these things for a long, long period of time. What are you getting from the signals that the shape of yield curves are giving you right now?
Yeah, the shape of the yield curve is one of the best indicators of what the market is expecting, not only from future growth, but also the future cash rate path. So if you think of the long bond, the volatility that you showed in that VIX chart, long bonds are whipping around, but it's interesting at the moment that the 10-year bond in the US is now below where the market thinks cash will be in 6 months' time. So the 10-year bond in the US is about 2.8, 2.9%, and the market's thinking cash will get to 3.5%. So, in the front end, you say, we believe what the Fed is doing, but the long end is saying, but you're not going to stay there for long.
So we might get potential easings coming through next year. We're seeing the euro-dollar market do that as well. Do you reckon that's a legitimate case, or do you think we might actually see the Fed go, not capitulate, but maybe go and take its foot off the gas a little bit and say, okay, let's go and see after this really aggressive tightening schedule we've done now, see how the economy evolves from here?
Well, historically, if you use the curve as your indicator, usually the curve is correct. The bond market kind of weighing up and saying, we don't think you're going to be able to hold the cash rate here is usually your best indicator. What the Fed is saying at the moment, though, certainly does look like they're going to continue pushing the rate higher. The problem will be that as you start to see that growth concern rise, as you start to hear more and more about a recession, whether or not they soften up that message and say, we've got inflation under control now, we can take some time to pause, I think that will be the kind of next leg of this story, because certainly that's what the long bonds are telling us. If you look back over the past 12 months, long bonds led the cash rate going up, and now that they're starting to come off, it's probably also going to lead when they have to capitulate and say, we've done enough for inflation now.